Hey everybody, welcome back to this YouTube channel. Today, we're gonna go through two stocks that I believe are cheap and oversold. A word of caution, however, these stocks are my investment ideas, and though they might conform to my strategy, it's your duty to research and investigate if these stocks are worth your time and investment. With that being said, let's get started with the first stock, MarineMax. MarineMax, ticker symbol HZO, is a boating and yacht retailer. They operate through 77 retail locations in the US and sell related marine products such as boat insurance, boat repair, and many more. In terms of valuation, because MarineMax is a specialty retailer, essentially a company that focuses on niche products, the best way to value this company is through the price to book ratio in comparison to the boating and yachting industry average. The price to book ratio is simply the market price of the share divided by the book value of the share. Essentially, the smaller the price to book ratio, the more valuable the company. The price to book ratio for MarineMax is 2.03, while the industry average is a whopping 110.84. Fundamentally speaking, this stock is extremely undervalued and could reasonably be a good stock to hold long term. Now let's move on to the technical analysis of HZO. Looking at the overall trend of HZO, the stock had a strong uptrend throughout last year and the beginning of this year, up until March, where this stock started doing more sideways action. Looking at the graph of HZO, this stock has support at the levels $45.75, $43.90, and $40.55. This means that your areas of cutting loss would be around the $43 to $39 levels, which if you were to buy at the current price of around $48 today, would be a $5 to $9 loss per each share. As for profit taking levels, the levels $58 would be a conservative take profit, while the levels $67.55 would be a reasonable reach. From our research, we believe that the catalyst for the stock to reach these levels would most likely be its earnings report on July 21st. According to NNMA, the National Marine Manufacturers Association, there's a lot of optimism behind the entire boating industry, as many reports have described that boat sales are up each month, sometimes over 20% from last year. Overall, if there's one thing that can push the stock up, it's hopefully MarineMax's earnings report on July 21st. As a word of caution, it would be smartest to wait for some kind of confirmation, such as the stock starting to show signs of an uptrend, in order to protect yourself from a stock falling even more. Now let's talk about the second stock, ArcBest. ArcBest, ticker symbol ARCB, is a logistics company that efficiently manages the supply chain of a company, essentially transporting a company's products from its point of origins to the point of consumption. Its valuation is a little bit more complicated. Its PEG ratio, a ratio that determines the value of a stock in regards to its projected earnings growth, is equal to 0.78 in comparison to the industry average of 9.90. However, while this might indicate that ArcBest is undervalued in comparison to the rest of the industry, ArcBest earnings are around a fifth of the overall industry average. This makes the valuation of ArcBest a little iffy, and therefore not the best stock to hold long term. Now let's move on to the technical analysis of ArcBest. ArcBest looks like a stock that had a very strong uptrend in the past until the strong sell-off that started around the month of May. Looking at the sell-off, it does raise some concerns about the stock itself. Is this an internal business issue, or is it a sell-off that was reflected from the overall market selling off? Looking at the top businesses in the logistics industry, such as FedEx and UPS, It can be seen that they had a sell-off around the same time, leading me to believe that this sell-off has something that is sector-related rather than the business of ArcBest itself. Perhaps it was a fear from rising oil prices that caused the sell-off in the logistics sector. For areas of support, this stock has support at $47.60, $55.20, and $59. Around $46 to $52 would be a place to cut losses if you were to come to it. If you bought around today's price point, being around $60, expect a loss of around $8 to $14 per share if the stock does start a downward trend. As for profit taking, $78.50 is a conservative level to sell the stock for profit, while $93.50 would be a reasonable reach. Again, just like the last stock, please do research before you buy into this stock, and most importantly, don't forget to wait for confirmation before buying it. And in conclusion, that is all. If you liked the video, hit the like and subscribe button, and have a wonderful day.